Hi, my name is Ben MacNevin from Montgomery Investment Management, and welcome to this week's Video Insights. If you've been following the blog recently, you would have noticed a number of posts sharing our thoughts on why the market may be a little on the expensive side. As an outside party, it may be difficult to relate to this content, as much of these justifications are based on our secret herbs and spices. So I thought it would be useful to present the same message from a different and hopefully more relatable perspective. So to do this, let's take a look at the graph on the screen. In yellow are analyst forecasts for the end of year earnings per share of companies in the ASX 200. Now this is in aggregate. In red is the price to earnings ratio, which is simply the price of the index divided by the EPS estimates. We have chosen the price to earnings ratio as a simple measure of providing a sense of general market valuations. So let's first examine consensus analyst expectations. You will note that the yellow line is punctuated by spikes at the start of each financial year, as these are fresh estimates for the year ahead rather than a rolling 12-month forecast. So analysts were too optimistic in FY12 and FY13 and had to subsequently downgrade their forecasts. Now, while consensus numbers have been relatively variable in FY14, it's likely that the upcoming reporting season should finish in line with expectations from the start of the year. Now, in contrast, the price to earnings ratio during FY12 was relatively low, which suggests that the market did a better job at anticipating the slowdown in various businesses, including those in the mining sector. This ratio increased considerably in FY13 from 11.5 times to 13.5 times, which suggests that the market moved ahead of analysts with expectations of stronger earnings growth in FY14, which ultimately transpired. Now keep in mind that the PE ratio was a forward estimate. Now, consensus market expectations, or PE ratios, have little bearing on the way we assess companies at Montgomery Investment Management. They are, however, useful as a guide in assessing the growth Mr. Market is expecting. Now, as the end of the 2014 financial year approaches, we find that the price to earnings ratio has been elevated to 15.5 times. To put this in perspective, the highest that the ratio has been in the past 10 years is just over 17 times. So we feel that a lot of future growth in aggregate is being priced in, and it seems to be at odds to consensus analysts who are forecasting just 6.8% earnings growth in FY15. So who will be right this time? The market, which has already priced in the growth, or the analysts who are forecasting a slower period ahead? If the earnings growth does not materialise, then there is a good chance that the PE ratio will meaningfully contract, or in market terms, a correction will occur sometime in the future. Our job is to determine on an individual company basis if future growth will materialise, and if so, determine a rational price to pay. While this doesn't mean there aren't opportunities out there for us to invest, we do feel that given the lack of wholesale market opportunities, there is sufficient downside risk to warrant average cash holdings of 38% across both funds. That's it for this week. Please follow us on Twitter and Facebook.